Has Wall Street finally lost its appetite for the energy drink stocks? I mean, here's a group that's had some stunning performance over the last 20 years. You think Alphabet's up big from its 2004 IPO with that 7,890% gain? Man, if you bought Hanson Natural, which is the company that became Monster Beverage at the same time, you'd now be up more than 24,000%. Meanwhile, in just the last 4 years, Celsius has rallied more than 4,700%. These things have been incredible winners. I mean, you think that they're AI, you think that they're, I don't know, networking or something. But in March and April, both Monster and Celsius turned ice cold, along with so many other formerly beloved growth stocks. Monster was down more than 15% in just over a month before stabilizing in the low 50s, ahead of its most recent earnings report last Thursday. Celsius plunged over 30% from peak to trough. I was starting to lose faith here.
Hello, everyone. Today, we're diving deep into Celsius Holdings, Inc., a company that's seen a bumpy ride recently, but is making strategic moves to strengthen its position in the energy drink market. Stick around until the end to find out if this stock is a buy, hold, or sell after its latest performance in Q3 2024. And don't forget, you can subscribe to our newsletter with the link in the description to keep up with more in-depth stock analysis like this. Let's kick things off with some context. Celsius Holdings reported a tough third quarter in 2024, with revenue dropping by 31% compared to Q3 of last year. This decline was largely due to inventory optimization by its biggest distributor, impacting revenue by about $124 million. While this hit hard, Celsius did manage to post a positive net income, showing some resilience amid these challenges. The company isn't just sitting back, though. They've been busy expanding into new regions like Australia and New Zealand, and even acquired Big Beverages, a long-term co-packer, to enhance their supply chain and drive innovation. Despite these moves, negative market sentiment has driven the stock to a 52-week low after an earnings miss. So, is this a potential buying opportunity, or is caution the way to go? Now, looking closer at the fundamentals, let's break down the numbers. Celsius reported $265.7 million in revenue for Q3 2024, down from $384.8 million in the same quarter last year. A big part of this drop comes from a disconnect between inventory going into the market and actual consumer sales, which hit gross profits too. Gross margins dropped from 50.4% to 46%, partly due to higher promotional costs. Despite the revenue drop, they maintained a positive net income of $6.4 million, showing that they're still managing costs well enough to stay in the black. On the strategic front, Celsius is clearly focused on growth. Their recent acquisition of Big Beverages could be a smart move, giving them better control over production and potential for faster innovation. Plus, their ongoing partnership with Pepsi is a strong lever for widening distribution and reaching more consumers. These initiatives could drive long-term growth and help Celsius stay competitive in the fast-moving energy drink market. Of course, no investment is without risks. The energy drink market is highly competitive, with major players fighting for consumer attention. Celsius also faces potential regulatory challenges and economic pressures that could impact spending. On top of that, relying heavily on a few big distributors leaves them vulnerable if those relationships shift unexpectedly. These factors are all worth keeping in mind when weighing Celsius's potential. Switching gears to technical analysis, let's look at the recent stock performance. Celsius Holdings stock has been highly volatile, recently dipping to its 52-week low following disappointing earnings and tough market conditions. Key indicators like the Relative Strength Index, RSI, and the Moving Average Convergence Divergence, MACD, suggest bearish trends with declining momentum. The RSI remains below 50, pointing to continued weakness, while the MACD histogram is in negative territory, reinforcing the downtrend. For those interested in entry and exit points, support is seen around $27.78, with resistance around $35.40. So, what does this mean for investors? Based on valuation, Celsius appears overvalued at a market cap of around $7 billion and a PE ratio of 29.74. especially in light of recent revenue declines and profit challenges. A fair valuation should consider both the company's growth potential and current headwinds. Given these factors, our short-term outlook for Celsius Holdings is negative. Over the next 3 to 6 months, the stock may continue to struggle with volatility and declining performance. Therefore, we're recommending a sell in the short term due to the current bearish market conditions and weaker fundamentals. For the long term, though, things look a bit more balanced. Celsius's strategic moves, like expanding into new markets and acquiring big beverages, could lead to meaningful growth over time. However, risks remain, especially in such a competitive space with dependency on major distributors. With that in mind, our long-term recommendation is to hold as the positive and negative factors balance out. This approach lets you keep a stake in Celsius's potential upside while staying cautious about the challenges. Thank you for watching. If you found this analysis helpful, make sure to hit the like button, subscribe to our channel, and share your thoughts in the comments below. For more investment insights like this, be sure to subscribe to our newsletter, link in the description. Disclaimer: this video is for informational purposes only and does not constitute financial or investment advice. Always do your own research and consult a financial advisor before making investment decisions. Investing involves risks, including potential loss of principal.